Hello and welcome to Morningstar. I am Francesco Lavecchia and with me today is Jelena Sokolova, Senior Equity Analyst at Morningstar. With Jelena, we are going to talk about the luxury company Swatch. So Jelena, in your last report, you highlighted two main factors behind the low market valuation of this stock. Could you please give us more colors about that?
Sure. Hi, Francesco. Thanks for having me. So first of all, I think the stock is undervalued. First, on the mounting concerns about Chinese consumers and general macro environment in China. Swatch is one of the highest exposed names to China in our coverage, so they are suffering from that. We take a little bit of a contrarian view. We still see China as a positive for Swatch. We think that there is significant pent-up demand for Chinese luxury consumption. It still remains more than 30% below pre-pandemic levels. And then the long-term drivers should be the increase in high wage employment. On the contrary, we see more downside for unusually high luxury consumption in the West, which was helped a lot by post-pandemic savings. Another thing that I think investors are concerned about is the competing technology, notably smartwatches. And we think that those smartwatches have been a meaningful headwind for Swatch lower-end brands for the last 5 years. However, we also think that some things are changing. Notably, the share of these lower-end brands in Swatch mix is less than 20% of revenue now. Then their sales are stabilizing, especially for Swatch brand, which is actually growing strongly on back of innovation. Another factor is that the high-end brands are actually not affected by smartwatch competition, as they have recovered very strongly post-pandemic. And finally, also smartwatch category is getting closer to reaching maturity, and the volumes are not growing as fast as they were, creating less headwinds for Swatch.
So in conclusion of our interview, could you share with us your expectations for the coming years in terms of growth and profitability and your fair value estimate for Swatch?
Yes, so we expect strong low double-digit growth for operating profit for Swatch, helped by both revenue growth, operating leverage, cost-cutting measures that the company has implemented in the past, and automation. We think that the stock is currently undervalued, trading at 11 times earnings only with this growth potential, and we see around more than 50% upside to our fair value estimate. The stock is currently trading in 5-star territory.
Thanks a lot, Jelena, for your time and for your insights. For Morningstar, I am Francesco Lavecchia. Thanks for watching.